Hello, and welcome to the First South Financial Podcast, where you're banking with friends. I'm Penny Hensley, the Senior Vice President of Mortgage Lending at First South Financial, and I'm joined today with Teresa Griffith. She's in Business Development at First South, and today we're going to talk to you a little bit about the 50-30-20 budgeting rule, so that we can hopefully help you understand what that is and how you can incorporate that into your daily finances. So, Teresa, tell me, what is the 50-30-20 rule?
Well, the 50-30-20 rule is basically where this tells you what to do with the money that you bring home from your paycheck. Mm-hmm. So 50% should go toward your needs, 30% toward your wants, and 20% toward your savings. And there's a lot that encompass each of those.
Now, is that before taxes are taken out or after taxes are taken out of your income? Okay. So explain to me, what are needs? What are the things that I need?
So your needs are going to include the things like your housing, your food, your transportation,
right?
Your clothes, not all of your extra clothes, but your basic clothes, and it's also going to include your debt.
Right.
So you have your, the typical needs, food, housing, shelter.
Right.
But then your debt, because you are obligated to pay that. So you want to make sure that that is included in your needs. It's not an afterthought and not nice to have otherwise. It is a requirement.
So as a mortgage loan professional, I'm thinking of the things that might show up on your credit report, those debts, those monthly debts that you're required to pay.
Right.
Okay. I understand that. So then, 20% goes towards savings, which I've always been taught, pay myself first. So what is considered those savings, or what are some vehicles as well that you could, how can you save money?
Yeah. So for savings, 20% encompasses your emergency fund, your regular savings that would save for, say, vacation or Christmas, holidays, or, down payment for a house.
Right.
But also, the third component of your, savings is your, retirement. So, we've got to save for, retirement starting in our 20s. Mm-hmm. So, that 20% will encompass all three of those. Now, the emergency fund, is something that should be, saved first. So that is 3 to 6 months of living expenses. Mm-hmm. So that will be 3 months if you have dual income in the household, 6 months if there's just one person bringing home money. And that sounds like a lot. So when you think of all of your expenses, mm-hmm. and then you multiply it by 6, you get a really big number. But the good news is you don't have to save it all at once. You save it little by bit, little bit by little bit. And that allows you to have that flexibility in your overall budget. So get to see how fast maybe you can get to $500, and then see how fast you can take that to $1,000, and then increase that from there to $2,500. Experts have put the numbers. Mm-hmm. To paper, and they have determined that if you save $2,500 and have at least that in your emergency fund, you can take care of the majority of the things. Now, it's not going to help you that much if a tornado comes and tears your house down.
Right.
But it will help if you have a busted tire on the way home. Sure. It will help if you have a medical emergency and need to go to see the doctor. So it's going to help with that. So ultimately, you want that 3 to 6 months living expenses, but you can take a couple of years to get there. You don't have to do it all at once. I was told this 50-30-20 rule when I was in my 20s, and I thought, there's no way I can save 20% of my paycheck. I made hardly anything. So 20% was like going to encroach on, my food.
Right, right.
So I just put my head in the sand and thought, nope, can't do it.
Right.
And what we do at First South is we encourage you to take your time and let you know those little micro steps that you can take to help yourself get there.
Sure. And, I always recommend to homeowners to have a couple of months of cash reserves. you never know when you might lose your job or something along those lines. And then that way, you could pay your mortgage, into the future until you have time to find another job.
Exactly.
Real quick, what are some of the vehicles that you can use to save for retirement or that sort of thing?
So retirement, most people have access, or many people have access to a 401k or a 403b at their company. Mm-hmm. So the first thing you want to do when planning for your retirement is to see what the company match is. So ask your HR person or benefits person if the company offers a match. And what that means is that usually it's $1 for $1. Sometimes it can be 50 cents for the dollar. So what would that mean? What that would mean is that if you put in $500, your company's going to put in $500. That's $500 extra money you just got. If you put in $3,000, your company's going to put in $3,000. Now, they're all going to have caps up to a certain dollar amount or a certain percentage, but you want to do at minimum what it takes to get that match so that you are taking home that extra income that you wouldn't have had before.
Right. And it's so important to invest in yourself at a young age. So many young people think that they will live forever, that they're never going to die. And they need to understand that if you start a 401k at a young age, you'll have plenty saved for retirement. Another thing I think you could talk about is what does First South offer in the way of maybe a CD or IRA or something along those lines that helps borrowers with their retirement?
Yeah. So, in addition to a 401k and 403bs, you can also contribute to a Roth IRA or traditional IRA.
Right.
We have those at First South Financial, and every year the government sets a certain dollar limit that you can contribute. So in addition to what you contribute to your retirement plan at work, you can also contribute to your IRA, whether it's the Roth or the traditional. So check this different for tax year to tax year. And also for those who are age 50 and above, there's an extra amount added on top that can be added to that because IRAs didn't exist when so many people were coming up. So those 50 and older can throw in a little extra money there as they get closer to retirement.
Well, one thing I talk to borrowers about when they purchase the home are your wants. I can tell you how much you can afford based on what I know, what those monthly bills are that I see on your credit report. But tell me about the wants, the things that I don't know about. Maybe they go bowling every Friday night. I don't see those things. So when you're looking to see how much home you can afford, you need to determine what do I enjoy doing? And I don't want to give those things up. So I need to remember that as part of my budget. So what are some of the wants that you talk about?
Well, so the key is to keep your wants 30% or lower.
Right.
And if your ratio of what you're spending on your needs exceeds that 50%, it's got to come out of the percentage of wants.
Right.
Okay. It doesn't come out of your savings. So your wants are those things that make life a little bit more comfortable, a little
like shoes.
Like shoes. Makes it a little bit more enjoyable. So those can be your hobbies. It can be if you're work 40 hours a week doing in an office,
right?
And then you want to go home and you want to paint or you want to sing or you want to play the piano or whatever. That's all of those wants. If your kids are in the extra athletic different clubs, that's going to be considered a want, not a need.
Right. Okay, so how do I determine if I'm close or if I'm way off on my needs and wants?
So one thing you can do is you can just look at where you're spending your money for the month. So you can either go through all of the expenses that you see in your on your bank statement, or you can do what's called a spending leak challenge, which is where you write down everything that you spend money on for 2 weeks minimum. 4 weeks if you can hack it. But when you do that, you'll see all of these little things that you may spend money on that are trivial at the time that you do it, but boy, do they add up. That's one way to get rid of some extra spending that you're doing. But also you will see all of your expenses. And that's really cool. The only thing that won't be in there are those things that might be paid on a quarterly or twice a year or annual basis, like insurance, property taxes, some of those things that are only annual.
Okay, so to kind of recap what we've talked about today, the 50-30-20 budgeting rule states that you should spend up to 50% of your after-tax income on needs and obligations, the things that you have to pay for. And then the remaining should be 20% towards your savings, and then leaving 30% to your wants. So on things that you want to do, but not necessarily that you have to do.
Yeah. And look at it as a structure, not as something that's really confining. So if you have considerable debt and you're more a 60-20-20, that's okay. As you pay that debt off, you will bring that money up for the wants. You won't have to do without so much as you get that paid off. So think of it as a framework to help you budget, as opposed to something hard and fast.
Right. Well, if you'd like to learn more about these budgeting tools, please feel free to come into any of our 18 locations at First South Financial or visit us on our website at firstsouth.com. We'd love to have you come and experience the credit union difference.
And if you would please refer us to your friends, like the show, comment, let us know other things that you would like to see, and subscribe. We would appreciate it.